Welcome to Bloomberg Markets. I'm Scarlett Fu. The equity market takes a big turn south after data show U.S. manufacturing activity shrank by the most in 8 months, one day after the Fed's no decision. So here's where things stand. Bad economic news is being interpreted, is being seen as bad for stocks, no matter the size. So you look at the S&P 500 and the NASDAQ 100 stocked with the biggest companies in the U.S., each down by at least 1%. They're at session lows. And of course, for the NASDAQ 100 and the S&P, we should mention this comes before Apple and Amazon report their earnings after the bell. The Russell 2000, of course, stuffed with small companies. They had been the beneficiaries of rotation away from tech. They're the weakest link today, off by 2.9%. But chip makers are getting hit the hardest there by more than 5%. By the way, the VIX is also moving higher, approaching 18. Today's data points included weekly jobless claims hitting an almost one-year high in manufacturing, shrinking the most in 8 months. Bonds rose, and that pushed yields lower as traders are now more convinced the Fed will cut rates in September. They're now pricing in 3 rate cuts this year. So to put that all into context for us, let's go now to Natalia Knežević to give us some equity movers and some more details on what we're seeing in today's trade. Natalia?
Hi, Scarlett. Let's start with those bets on interest rate cuts. We now see that the market is pricing in 3 rate cuts by the end of this year. Of course, that came on the back of yesterday's Federal Reserve's meeting. Today, we also got, as you mentioned, weaker than expected economic data, jobless claims, and ISM manufacturing. But now some traders, if we look at the price reaction in the stock market, are concerned that maybe weak economic data is getting bad for the stock market. Let's flip up the board and look at some of the biggest movers today. Of course, Tesla, it is up by 6%. The key takeaways from the earnings report is that sales came better than expected, and targeted investments in AI will be helping the company to sell advertising in a more targeted way for its consumers. So we got a couple upgrades on the stock. It keeps moving higher. Let's take a look at consumers segment. We got really interesting reports from 2 burger chains. So the first one is Wendy's. The stock is down by almost 1%. The company cut its guidance, and it posted weaker sales across all chains. And this is another indicator that higher prices are hurting U.S. consumers. But on the flip side, we got Shake Shack. This stock is absolutely soaring. It's up by 15%. The company raised its full-year guidance, and analysts are pretty optimistic about the stock. Let's look at positioning and flows. It's also important when we look at market moves. So this chart shows CTAs, commodity trading advisors, positioning. Typically, the way they operate, when the market moves up, CTAs and other systematic funds, they increase exposure. When market goes down, what happened last week, they reduce exposure dramatically, and the stock market really feels this pain. So this chart shows that last week they reduced exposure by about 50%. That's one of the biggest declines over the past year and a half. And as of now, the biggest question is, will they keep decreasing their leverage to U.S. stocks or not? And some analysts I spoke with, they say, yes, there is still room to run, and now everything depends on fundamentals, such as earnings.
It all comes back to earnings. Natalia, thank you so much, as always. Fantastic wrap-up of their equity movers, as well as the positioning we see in the broader equity market. Now, it is a big, big week for central banks. The Bank of Japan and the Fed yesterday, of course, and the Bank of England today. And for the BOE, today's decision featured the first rate cut since early 2020. Investors snapped up UK bonds, and higher price means lower yields. That means the yield on the 2-year was down the most since last December, as investors brace for further easing from the central bank. Bloomberg's Francine Lacqua sat down with Bank of England Governor Andrew Bailey. Take a listen.
Well, we were looking for, in a sense, for sort of confirmatory evidence. We weren't looking for something to change necessarily. It was confirmatory evidence. We had that. I think we had, certainly my own view is we had that. But we will be looking at this framework and saying, are we seeing this sort of rather more benign comp process, which we can sort of further confirm Or does this sort of structural issue, which is why we've put this sort of risk in, that maybe COVID, for instance, has changed some elements of the structure of the economy, which is going to make the thing more sort of resistant, if you like, to measures to get inflation down. And that's the judgment we will have to keep coming back to.
Where do you think rates settle? Is 4% restrictive?
We don't have a number on it. What I would say is this. I think it's reasonable. Don't expect we're going back to zero, because zero was the product of huge global shocks, starting with the financial crisis, then obviously COVID as well. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Governor, the government has said it will borrow an extra £16 billion this year. Does that change the calculus around rates?
Well, I'm going to wait for the budgets on the 30th of October to see the full picture, because we always condition on an announced fiscal policy. That's what we will see at the end of October, and we'll sort of put it through the machinery at that point. So
the Fed, the ECB, the BOJ are all adjusting policy, and that's very clear, and that's trying to some big change in foreign exchange markets. What are those, what of those elements are actually important to you and BOE policy?
Well, we obviously don't have any target for the exchange rate. That's all a long way in the past in terms of that sort of thinking. But obviously, the exchange rate feeds through in terms of financial conditions. We've seen some appreciation of sterling since we did the last report and forecast in May. Sterling has appreciated. We fed that through, as it were, so it changes import prices and so on. And that's how we tend to look at it, actually. I would say recently, over the last four or 5 years, actually, in the sort of transmission of mechanism of monetary policy, exchange rates have not played a very large role. And I think the reason for that is because we've all been facing essentially global shocks. So these are not sort of specific shocks that affect one central bank but not another. We're all in the same place, really.
And of course, that was the BOE governor. So let's discuss this further now with Bloomberg Opinion's Marcus Ashworth in London. Marcus, I've read commentary from a currency strategist calling this a hawkish cut, yet we also see traders betting on 2 more rate cuts by December. Which one is it?
It's a rather dull, cautious cut, because they're trying to slot in between the European Central Bank has already done this. They've copied their template. Everyone's waiting for the Federal Reserve. Come on. If the Fed cuts in September, and more importantly, signals are going to keep on cutting, you'll hear the mood music change instantly in Europe, because no one wants to go ahead of the Fed. They've both had to, because their economies are so much weaker. And it's evident that inflation is beaten in the UK. Yes, there's some sticky service inflation. There's always going to be something which is sticky. But really, they couldn't. And it's only a 5-4 decision, which bewilders me. But nonetheless, thank the Lord, they've actually managed to have the courage to cut. We're down from 5.25% to 5%. It's still, as they admit, very restrictive. They're expecting inflation at 1.5% in 2 years' time. This is obviously a disconnect here with policy, that they just don't want to make any mistakes. They'd rather be proved wrong, should we say, on the fact that growth collapses rather than inflation rises.
Yeah, and of course they're waiting, as you mentioned, for the Fed to take the leap. What does a rate cut mean, Marcus, for the new Labour-led government?
It means, it means thank you very much. Welcome to your new home, and have a lovely day, because that's really what it's all about. I mean, look, it's just, if there was any doubt that Rishi Sunak calling the election early was a bad decision, this just completely, totally compounds it. And I guess that the Labour government will go, thank you very much, put that in the pocket and move on nicely, because they're doing some things which are slightly odd for their alleged growth agenda, by both cutting public spending and very clearly signalling taxes are rising, particularly on wealth, entrepreneurial type growth strategies. So they need a rate cut here, and they need several rate cuts. So they'll be very happy indeed, I suspect.
So we know that the BOE economist Hugh Pill will be speaking tomorrow. What will you be listening for from him, given that so much of what happens next depends on how the Fed proceeds?
Hugh Pill slightly bewilders me. He's just been confirmed again for another term as chief economist. He was one of the only internals, should we call them, who voted against a rate cut. Very odd. He had made a speech a while back, which in June, which had said that he was clearly leaning towards a hold. So that's fair enough. But I can't understand. This is a guy last summer, a year ago, basically saying, looking at the market rate pattern, that we should be cutting rates. And then now he's saying we should be holding. And when it's evident inflation's collapsed from 11% down to 2% target. I don't get him, and I don't get his understanding of where he thinks the economy is. I respect why he's wanting to be cautious, but at some point you have to understand the economy. You can overdo restrictive monetary policy. I think the Bank of England is starting to appreciate that they are at risk of doing that. That will be a policy mistake. Their chief economist, who should be leading the charge here, is in a different field. I don't understand. So I'll be interested to see what he thinks.
Yeah, well, we'll see if we detect any change in tone from him then. Marcus Ashworth, Bloomberg opinion writer, thank you so much for joining us as always. Really appreciate it. Coming up on Bloomberg Markets, we turn to the great rotation out of big tech with Youngwoo Ma of BMO. This is Bloomberg. A day after the Fed held off on cutting rates, we're getting evidence of weak economic data in both manufacturing and jobs. Now, that is sinking stocks but lifting bonds. The 10-year yield falling below 4%. Youngwoo Ma is BMO Wealth Management Chief Investment Officer, and he joins us now. Youngwoo, can you explain to me the dynamic here? Because bad economic news was once seen as good for stocks and bonds. Today, though, it's good for bonds but not good for stocks.
Yeah, thanks, Scarlett. It's great to be here. The bad news is good news for stocks is a very fine line to walk. It works until it doesn't. We do think that there is some possibility with the uncertainty that's out there that we'll get some continued soft economic data between now and the next Fed meeting. And there's a lot of time between now and then. There's a lot of time for the market to think the Fed's behind the curve. If that happens, there's a lot of prospect for even the labor market to weaken more over the next 2 months. So we think that uncertainty is really going to, at least has potential to weigh on the markets here. Okay, and as a result of the data that we've seen today, we're now seeing bond traders pricing in 3 Fed rate cuts this year. Previously, there was a lot of talk of 1 to 2, and most people kind of settled at around 1 to 2. Now it's 3 rate cuts. How do you see this playing out for the rest of the year? I mean, Jay Powell made clear that he's keeping September on his calendar as the next point because that is the next FOMC meeting, and he'll probably use Jackson Hole as an opportunity to shore up that kind of messaging. But how do you see it playing out in terms of actual cuts? Is it 25 basis point cuts over the next couple months? Yeah, that's a very good question. We've actually been talking for the past few weeks that there's a real possibility that the Fed could cut rates by 50 basis points at the September meeting. The market, I think just today, is putting in that probability at around 20%. Before, when we started talking about that, the market was having that probability around 5%, which we thought was a gross underestimation of the possibility for labor market or other economic weakness between now and September. The Fed just wasn't in the mindset of cutting rates at this meeting yesterday, although when you look at the arguments and the questions that Chair Powell received from reporters, really there's a lot of potential to even start rate cuts then, or at least the arguments for starting rate cuts yesterday were quite sound. So we think that adds the potential for the possibility of a 50 basis point rate cut in September. But we don't think that 3 rate cuts this year is an unrealistic possibility. There was a while where we thought 2 was probably more likely. But if we see just a little bit more weakness, as Chair Powell said, the Fed has a lot of room to maneuver here and ability to cut rates. So it could shift pretty quickly, especially if it gets perceived as being behind the curve.
Yeah, and of course that puts extra importance on tomorrow's jobs report. Right now, the consensus estimate is for an addition of 175,000 jobs after 206,000 jobs were recorded for the month of June. So put this all together, Youngwoo, and talk to us about how this fits in with the mindset in equity markets right now. We have this great rotation that is still kind of in play, even as the Russell 2000 is underperforming the big caps, but there's a hunt for weakness. People seem to be biased towards worrying about big cap tech names and whether the earnings they're releasing are justifying recent gains.
We do think that the market really is trying to sniff out weakness in areas anywhere it exists, really focusing on that weakness. We don't think momentum will build to the downside. So to the extent we do see mixed data or some weak data over the next few months before the Fed's rate cutting campaign kicks in, we do think it's going to be a campaign, by the way. We think that rate cutting is going to continue throughout 2025 as well. So we think that the big picture items are still relatively sound. But the market, amid the uncertainty that we have, especially before the election, the market could get a little bit jittery here, especially given the run-up that we had last year and the first half of this year. So, the rotation we think is going to continue to happen, or at least the small caps and mid caps having a bit of a catch-up trade. Mm-hmm. But that could pause for a bit until the rate cuts get underway. We think that's a possible scenario as well.
Gotcha. By the way, we're looking at a live shot of the White House right now as we await President Biden to come out and make some remarks on the prisoner swap with Russia. We'll bring you there when he does come out to speak. But Young-Yu, I want to go back to you on the markets. You talked about how the catch-up trade in small caps is probably still intact. It still has some room to run, even if it does pause for now. Where are we in this rotation trade overall? Are we in the first inning? Are we in the ninth inning? Because I'm curious to get your take on how much distinction investors are making between different sectors within small caps.
Yeah, in the early stages, everything's going to rally, but we're possibly in the third or fourth inning, but it's going to depend on the extent of rate cuts. And we do have small cap earnings expected to accelerate by the end of the year and into next year. If that continues, the rotation or the catch-up trade, as we probably should say, is likely to continue well into 2025. And then there's a question of whether or not we get tariffs if former President Trump should win the White House. That could add a little bit more fuel to the fire.
Got it. All right, Young-Yu, really appreciate your joining us. Young-Yu Ma joining us, the Chief Investment Officer at BMO Wealth Management. Let's go now to the White House where President Biden is delivering remarks. Let's listen in.
Got everybody? Well, good afternoon. And this is a very good afternoon. A very good afternoon. Today, we're bringing home Paul, Evan, Alsu, Vladimir. 3 American citizens and 1 American green card holder. All 4 have been imprisoned unjustly in Russia. Paul for nearly 6 years. Vladimir since 2022. Evan since March of 2023. And Alsu since October of 2023. Russian authorities arrested them, convicted them in show trials, and sentenced them to long prison terms with absolutely no legitimate reason whatsoever, none. Paul, a former Marine, was in Russia for a wedding. Evan, a journalist with a Russian, in Russia, was in Russia, assigned by the Wall Street Journal. Alsu, also a journalist, was in Russia to see family. All 3 falsely accused of being spies. And Vladimir, who was a Russian citizen by birth and holds an American green card, is a Pulitzer Prize-winning journalist and was a pallbearer at my friend John McCain's funeral with me. He spoke out against Putin's regime, and for that he was convicted of treason. And now, their brutal ordeal is over, and they're free. Moments ago, the families and I were able to speak to them on the telephone from the Oval Office. They're out of Russia. Earlier today, they were flown to Turkey, and soon they'll be wheels up on their way home to see their families. This is an incredible relief for all the family members gathered here. It's a relief to the friends and colleagues all across the country who've been praying for this day for a long time. The deal that made this possible was a feat of diplomacy and friendship. Multiple countries helped get this done. They joined the difficult, complex negotiations at my request. And I personally thank them all again. And I've thanked them personally, and I'll thank them again. All told, Russia has released 16 prisoners. 8 Russians who are being held in the West will be sent home as well. These 16 prisoners from Russia that Russia has released include 4 Americans, 5 Germans, 7 Russian citizens who are political prisoners in their own country. One of those Russians runs a human rights organization, Memorial, which won a Nobel Prize in 2022. Putin threw him in prison for voicing opposition to the war in Ukraine. 4 others work with Alexei Navalny, political opposition leader who died in Russia prison this year. Now they can live safely abroad and continue their work of advocating for democracy if they so choose. This deal would not have been made possible without our allies. Germany, Poland, Slovenia, Norway, and Turkey, they all stepped up and they stood with us. They stood with us. And they made bold and brave decisions, released prisoners being held in their countries who are justifiably being held, and provided logistical support to get the Americans home. So for anyone who questions whether allies matter, they do. They matter. And today is a powerful example of why it's vital to have friends in this world. Friends you can trust, work with, and depend upon, especially on matters of great consequence and sensitivity like this. Our alliances make our people safer, and we began to see that again today. Let me say this. It says a lot about the United States that we work relentlessly to free Americans who are unjustly held around the world. It also says a lot about us that this deal includes the release of Russian political prisoners. They stood up for democracy and human rights. Their own leaders threw them in prison. The United States helped secure their release as well. That's who we are in the United States. We stand for freedom, for liberty, for justice, not only for our own people, but for others as well. And that's why all Americans can take pride in what we've achieved today. I want to thank everyone in my administration who helped make this happen. Our work did not start just on day one. It started before day one. During the transition, I instructed our national security team to dig into all the cases of hostages being wrongfully detained, which were inherently, well, we inherited them from the prior administration. I wanted to make sure we hit the ground running, and we did. As of today, my administration has brought home over 70 Americans who were wrongfully detained and held hostage abroad, many since before I took office. Additionally, I issued an executive order in 2022 authorizing penalties like sanctions and travel bans on those who hold Americans against their will. And my State Department has introduced new warnings for Americans about the risk of being wrongfully detained by a foreign government. Deals like this one come with tough calls, and there are never any guarantees. But there's nothing that matters more to me than protecting Americans at home and abroad. And so we'll continue to work for the release of all wrongfully detained Americans around the world. Let me end where I began, with Paul, Evan, and also Vladimir and their families. They never gave up hope. We can't imagine what they've been through, all of you. Matter of fact, this lady right here, I think, was living in the Oval Office with us for a while. All kidding aside, can't imagine their joy right now. They're home. Tomorrow's a big day, the 13th birthday of Miriam. Miriam, where are you? Come here. You all know we have a tradition in the Biden family. We sing happy birthday on any birthday. You ready? All of you. Happy birthday to you. Happy birthday to you. Happy birthday, dear Miriam. Happy birthday to you. Remember, no serious guys till you're 30. God love you. She's Alsu's daughter. Now she gets to celebrate with her mom. That's what this is all about. Families able to be together again, like they should have been all along. So I want to thank you again to everyone who did their part. In just a few hours, we'll welcome home our fellow Americans. We're looking forward to that. God willing, we're going to be out at Andrews and get that done. So thank you, thank you, thank you. And this is a good day.
What did you say to them on the phone, sir? What did you say when they answered the phone on the other side?
I said, welcome almost home.
Other countries, these so-called abductor states, from simply taking more Americans in order to get more of their prisoners home? How do you end these perverse incentives, sir?
Or advising people not to go certain places. Tell them what's at risk, what's at stake.
These negotiations, and can you speak to the complexity of working with 6 countries to secure these releases?
Well, look, I'm not going to take the time now, but I'll do this later in the week. I particularly own a great sense of gratitude to the Chancellor. The demands they're making of me required me to get some significant concessions from Germany, which they originally concluded they could not do because of the person in question. But everybody stepped up. Poland stepped up, Slovenia stepped up, Turkey stepped up. And it matters to have relationships. It really does. These things matter. Pardon me?
Could this improve relations with Russia? Is there any avenue for that after this prisoner exchange deal?
As my sister might say, your lips to God's ears, man.
Did you speak with Vladimir Putin about this, or would you be willing to speak with Putin now directly?
I don't need to speak with Putin.
Anyway. How did you weigh that decision of letting somebody out who sounds like got away with murder?
I got home innocent people. Thank you. All right. Thanks, everybody.
President Joe Biden there at the White House making remarks on the prisoner swap that was announced today. An exchange of 24 prisoners. It is the largest since the Cold War era and includes U.S. hostage Evan Gershkovich, who is a Wall Street Journal reporter detained in March 2023, as well as Paul Whelan, a former U.S. Marine who was detained back in 2018. Let's bring in now Kelly Lyons, who is in Washington, to give us a little more context on this. And Kelly, we heard from President Biden that he was thanking allies. He said there were 6 countries involved. He actually gave a shout out to the German chancellor as well, saying it matters. Oh, you know what? Let's go back to President Biden at the White House. He's still speaking.
Help. It matters.
Mr. President, what did Germany ask for in response for their cooperation?
Nothing.
President Biden,
What did Chancellor Scholz say?
President Trump has said repeatedly that he could have gotten the hostages out without giving anything in exchange. What do you say to that? What do you say to President Trump now, former president?
Why didn't he do it when he was president?
Sir, what did Chancellor Scholz say?
Thank you, guys.
Let's go back now to Kelly Lyons. Again, President Biden leaving the White House East Room as he finished making remarks on the prisoner swap, the largest since the Cold War era. 24 prisoners exchanged. Kelly Lyons, the Bloomberg Balance of Power co-host, who's been listening to the news conference as well. Kelly, a lot of those questions at the very end really touched on the relationship between the U.S. and Russia, but also the U.S. Ties with other countries that helped affect this prisoner swap. Can you give us a little more context on the countries that were involved and the level of diplomacy that required?
Well, as we just heard the president say, Scarlett, these were intense and very complicated negotiations with so many countries that needed to be at the table. This wasn't just about Russia and the United States, but other countries as well, which he did there mention by name: Germany, Poland, Slovenia, Turkey, and Norway, all involved in this. And he did, as you alluded to, shout out specifically the German Chancellor Olaf Scholz. We know, of course, that one of the key linchpins in this exchange happening was Vadim Krasikov, who was a Russian who was detained for a life sentence in Germany after killing a Chechen rebel former commander in Berlin in 2019. Vladimir Putin had been advocating for his release in particular for years now, going back to 2021. So convincing Germany to swap him for some of these other individuals was really critical. Of course, as we heard President Biden outline there, this was not just about American prisoners, although 4 of them were released today, including those journalists, also Kurmasheva, and, of course, Evan Gershkovich of the Wall Street Journal. But this also was about freeing some Russian political prisoners who had been advocating for what Biden described as human rights and democracy, which, of course, he says the United States holds very dear. And he said that really speaks to the efforts of the United States. But he really made this not about just this prisoner swap, but about the alliances that allowed it to happen. He said, and this is a quote, "If anyone questioned why allies matter, they do. They matter," talking about how deals like this come with tough calls and, of course, tough negotiations that a lot of countries had to be involved in. I would point out you did hear a question asked of the president when his remarks were finished, talking about criticism the idea that swaps like this actually encourage Russia to take more prisoners hostage, essentially, in exchange for getting actual former Kremlin officials and others who have been, in the view of the West, properly incarcerated out. This is something that we heard the House Foreign Affairs Committee Chairman Michael McCaul talking about today. He said he remains concerned that continuing to trade innocent Americans for actual Russian criminals held in the U.S. and elsewhere sends a dangerous message to Putin. Of course, when President Biden was asked about that, he said that the way the U.S. is avoiding that is by encouraging people not to go to areas in which it may be dangerous.
Yeah, I liked how this turned into an impromptu news conference there. We didn't necessarily expect that. There was one thing that was thrown President Biden's way, and that was about a comment President Trump had made as well regarding prisoner exchange. Trump basically saying that under him, he would have gotten it done immediately after he won the election in November of 2024, but before he was inaugurated. And President Biden had a pretty good response to that.
Yeah, he basically said, why didn't he do it when he was president? It is worth noting that a lot of those that were detained today have been detained since the time that Donald Trump was in office. One exception is Paul Whelan, that former U.S. Marine who had been incarcerated. Of course, this is the second time we've seen a prisoner exchange of this magnitude done under this administration. The first, of course, being in 2022 when the WNBA star Brittany Griner was freed. They were not able to get Paul out at that time. And Biden has been talking for the last 2 years about wanting to get him, Evan, and others like him freed. And I would point out the president did say today, he said it in his statement as well that was released earlier, this notion that there are still Americans being wrongfully detained abroad, and he wants to continue to work to bring them home.
All right, good stuff. Thank you so much for the wrap up, Kelly. Kelly Lyons, Bloomberg Balance of Power co-host, and of course you can catch her in about 30 minutes time here on Bloomberg Television. Let's just return for a moment to the financial markets here, because we're bumping along the bottom here when it comes to equity markets. The Russell 2000, the underperformer, losing about 2.8%, with all 11 groups in the red, but certainly big caps are lower as well, and tech is pacing the decline. So everyone's giving back some of yesterday's gains. The 10-year yield, you can see there, coming down below 4%. Traders are now pricing in 3 rate cuts this year on the back of some weaker economic data, particularly when it comes to manufacturing, and that puts a larger focus on tomorrow's jobs report due out at 8:30 a.m. Now, of course, the big tech rally is showing signs of sputtering today, as we just showed you with the NASDAQ 100 ahead of earnings out of Apple and Amazon. So let's bring in Bloomberg Opinion's Dave Lee for a little bit more here. And Dave, of course, the focus when it comes to these big cap tech names is their spending on AI and whether it's paying off. And you wrote a recent column that talked about the AI commercials Google is airing right now during the Olympics, and how it's a really good metaphor for what investors are kind of wondering about as well.
Yes, I mean, this was an advert that showed a young girl planning to write a fan letter to an Olympic athlete. And rather than sitting there with her dad and writing it out like you'd imagine, a sort of nice exercise for parent and child, instead she turns to Google's Gemini bot and generates the letter to the athlete. And people were watching that thinking, really? Like, is that really what this is going to be used for? And the reason why I mention it in the column is that it could be a metaphor for the entire industry right now. You have investors wondering, all these billions of dollars in capex, which is growing quarter by quarter. Do we really know what people are going to use this for, and is it going to be worth that money? And what we're seeing, particularly in this quarter, and as I sort of mentioned in the column, is there's not this sort of satisfying answer just yet. What investors are being told is, sit tight.
Yeah.
But in the meantime, we're going to keep on spending massively. And that's starting to make people, after the huge optimism earlier this year and late last year, people are starting to go, okay, well, when's this going to pay off for us?
Well, the believers say, this will require years of investment and it'll take years to pay off, but it's a long-term benefit. The issue is, what has made people sit up and say, we want to see a return today, or we want to see concrete evidence of something now in the second quarter of 2024?
Well, I mean, there are people that, as you say, there's a sort of long-termist view, but there was some expectation that some of these things were going to start to pay off a bit sooner. So you look at a company like Microsoft, their stock dropped when they announced their earnings earlier in the week, and that's because the cloud growth wasn't quite as big as people thought it was going to be. Now, the issue Microsoft has is sort of showing people that AI is going to be a driver of companies investing more in the cloud. This quarter, they said around 8% of their growth of their Azure cloud unit could be directly attributed to AI. That's up from 7% the quarter before. So it is growing, but it's getting slower. What some of the other companies have done, and we saw Meta do this as well, is sort of say, well, look over here at this one thing that is working and ignore the spending over here. So in Meta's case, their advertising unit up 22% year on year. They said much of that was down to AI powering better recommendations for advertising. And that was great for investors, which is why Meta's stock performed much better than Microsoft, because they believed it. They believed that AI was going to help in the short term with advertising.
Or they framed it better. Meta framed it better in terms of it giving an answer that investors wanted to hear. Here is what AI has done for us. But their advertising business was going to do well regardless. I mean, this is an election year, and also you've got a lot of spending on the Olympics.
Yes, exactly. That's always I feel that's a big question here, because Meta has always been an advertising business. You know, did it need to spend billions of dollars in capex in order to continue being a successful advertising business? I mean, possibly not. I mean, in the future, and Mark Zuckerberg talked about this with investors, he said they hope that eventually companies will be able to just describe what they want to achieve with advertising, and AI will do that for them. And then, yes, in years' time, their assistant would be useful for all sorts of things, and you know, AI would bring these sort of long-awaited benefits. But even Mark Zuckerberg, who is, you know, one of the biggest optimists on AI in Silicon Valley, was very cautious to say, yes, we're getting some benefits now, but really the payoff will be years. And he reiterated something he said before, which is, you know, Meta's investors have wondered about things paying off before.
Yeah.
And he says they've always come good, which is a fair thing. They have always kind of come good on that. So he's kind of trying to play both ends here.
Of course, we're going to get earnings from Apple and Amazon. We'll be speaking with an analyst in greater detail about what those numbers might show, but I'm guessing it'll be more of, you know, just be patient, it will come, especially when it comes to Apple's newest iPhone that will be AI enabled. The one company that has seen a flow through to its top line and bottom line is NVIDIA. But that company doesn't report earnings until late August. So we have this long, barren period in which we're just kind of wondering whether we're going to get more concrete evidence that AI is paying off. How do you see this playing out?
Well, I think NVIDIA might end up being the kind of canary in the coal mine of this entire industry, because it's at NVIDIA where the journey to invest in AI begins. People go to NVIDIA and they buy the chips to start training their models, to start running their models when they're ready. So, you know, they've been the biggest beneficiary and the earliest beneficiary, but they might end up also being the company that sort of we see suffering, if you like, at an earlier point to some of these other companies. Because every analyst I talk to, they all say, well, the demand's got to tail off at some point. We just don't know when it's going to be. And that's going to be the telling point for NVIDIA,
All right, so watch NVIDIA's earnings, August 28th, I believe. Dave Lee, Bloomberg opinion writer Dave Lee, thank you so much for joining, and we'll check in with you later when those companies do report their results. Now, coming up on Bloomberg Markets, let's get into the weeds and look at Apple and Amazon earnings with Laura Martin from Needham. She's going to give us her take on what she's looking for from those companies. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. We have the NASDAQ 100 currently at session lows, and within that index, 85 stocks are in the red. So 85% of the members are declining. So a broad retreat here. And of course, Apple, one of the biggest losers, which makes sense given that it's part of the group of companies, the mega cap techs, that are under a little bit of suspicion over whether their investments in AI will pay off. Because after the bell, Apple does report its latest earnings. The stakes are high. It has reported a drop in sales in 5 of the last 6 quarters. Now, for the second quarter, the quarter that just ended, analysts are anticipating a recovery in sales, a gain of 3%. And they're also anticipating details about the Apple Intelligence features that will be included in the latest iPhone. Needham senior analyst Laura Martin, has a buy rating on Apple and joins us now. So, Laura, 3% revenue growth does not sound amazing. What is helping it recover, given that so many people are holding off on buying iPhones, particularly in China, and waiting to hear more details about the iPhone 16 when it does come out?
Right. So I think this stock has gotten much more interesting as a debate topic because you're exactly right. The big issue that's being debated on Wall Street is whether the generative AI features they promised are going to be in the iPhone 16, which gets released next month, or whether we have to wait a year. And if those AI features are enough to drive an iPhone replacement cycle starting this year, or whether people wait. I happen to think it's going to take another year, but their stock has been running on the fact that they think there'll be enough generative AI like efficiencies and tools and features in the current iPhone, the 16, which will be released in September, that people will start replacing their iPhones now. Because like of their total revenue of $84 billion in the quarter that we're expecting for this the June quarter, half of that is iPhones. So the iPhone is the only product big enough to actually move the growth rate of Apple from 3% to 4 to 5. Nothing else is big enough by itself, no other product, to move the actual entire revenue growth rate of Apple.
Yeah, it's astounding because products brings in $60 billion on the top line. Services brings in $24 billion. So it's a fraction of products, which, you know, is really the iPhone when it comes down to it. What is Apple doing when it comes to services in the lead up to the rollout of Apple Intelligence? I mean, it's certainly helping to boost margins a bit.
Yeah, because we're looking at 14% growth for services at a 75% margin. So it really helps there. And therefore, that should drive about 100 basis points of margin expansion for the enterprise. So services are really powerful. What they're doing is they're bundling more services together to give you a discount. They're doing family plans. So it's really hard for anybody in your family to exit or to use a Google or an Android phone, actually. So they're doing more and more things to try to lock you into that iPhone ecosystem and then sell you more and more services and products like the Apple Card or Apple Pay, or they're trying to really load you up with services because they have such a high margin for Apple.
Okay, let's shift gears over to Amazon, which I know that you're more excited about. Just on the top line alone, we're anticipating 11% sales growth for the quarter that just ended. A big part of this will be Amazon Web Services, but based on what we heard from Alphabet and from Microsoft, how much optimism can you really fold into what we're going to get from AWS and how much it's monetizing off those AI investments?
Right. So this is the big question we need answered tonight, because Google or Alphabet, when they said they're going to have all this CapEx, the stock was down 3% after a really solid earnings report for the June quarter. Yesterday, Meta said the same thing. They're raising their CapEx guidance. It's going to be up more next year, but the stock's up today. So what we need to see is when Amazon comes out and says they're going to spend a ton more money on building AI infrastructure, we need to see what the stock does, whether investors are giving these companies a pass when they invest in Gen AI, or whether they're going to be mad that their earnings is going to have a headwind because they're investing so billions, tens of billions of dollars in these data centers for generative AI. And I'm really looking for advertising, too. We want advertising to grow here at 20% because we think it has 70% margins over at Amazon. So that's a big, important number to us also.
70% margins is pretty incredible. What about the retail business? I don't expect that the margins in retail is as juicy as what we saw in the other parts in advertising, but certainly it's a part of the business that Amazon's focused a lot on making more efficient, and it's starting to pay off, isn't it?
Yes, we're looking for 300 basis points of margin expansion to about 9% operating margins. And cleverly, when they added all those ads to your Amazon Prime Video, they're actually tying those ads to purchases, which means they're getting more purchases. And remember, we had a Prime Day. So I think that we're going to get better e-commerce numbers and maybe at higher margins, thanks to the flywheel of having all of these connected television ad units from Prime Video driving more e-commerce sales on Amazon.
Yeah, it's a tale of ecosystems, whether it's over at Apple or whether it's over at Amazon. Laura, always appreciate your speaking with us. Laura Martin of Needham joining us for a preview there of Apple and Amazon earnings. Coming up, we're going to talk about real estate, why Greg Friedman, whose firm owns more than $6 billion in real estate, says the sector is shifting to normalization. This is Bloomberg.
I read a statistic today that Jan Freitag put out that luxury had a 9% demand growth in the month of June. The economy end of the hotel segment, I think, was, about a 2% drop. So we're in the right sector.
That was Trinity's Sean Hare explaining how luxury real estate continues to remain strong as we see cracks in other areas of commercial real estate. I'm pleased to say Greg Friedman is joining us. He is managing principal and CEO of Peachtree Group, which owns more than $6 billion in properties. And of course, our very own Abigail Doolittle as well. So, Greg, thank you so much for coming in. I know that you're visiting from Atlanta, and we'll get to some of your real estate portfolio and what's in there, much of it in hospitality. But I wanted to just get your state of play on what Peachtree sees in your home base of Atlanta right now.
Yeah, I mean, I think Atlanta's a thriving city, so it's still doing well. But as it relates to commercial real estate, it's definitely a challenge. I think Atlanta represents the U.S. When you look at commercial real estate, it's a very challenging time across the board. And a lot of that challenge, you have the challenge in the office sector, which is really more secular distress. And then you have this balance sheet stress that everyone's dealing with, that's related to just interest costs being so much higher than what it was going back a couple of years ago.
So let's talk about that balance sheet stress, because of course, relative to Peachtree Group, you have about $6 billion worth of real estate, 70% on the credit side. So you really get to see the plumbing of the system. Josh Zegan of Madison Realty Capital joined us not so long ago and said it looks really, really bearish. The folks that we've talked to who are closer to the banks, closer to the financing, thinks that the commercial real estate playbook in terms of this cycle, worse for longer as opposed to just the equity side. You happen to see both. So where are we? Like, what inning, how bad is it? How long is it going to take to come out of this?
Yeah, so I think unfortunately, I think it's going to take a couple of years to come out of what's happening right now. We're going through a very sluggish cycle for commercial real estate. It's been that way the last couple of years, and values have come down dramatically across the commercial real estate ecosystem. There's been some stabilization of values over the last 6 months, just given there's still a lot of capital chasing commercial real estate. But the reality is there's a lot of challenges ahead because we've entered this new rate reset that's really impacted real estate values long term. So we went from a decade pre-2022 where we had 0% interest rates and cap rates were much more compressed than what we're seeing today, and where cap rates are probably going to settle out long term.
So if we're talking about the equity side and specifically hotels, in terms of what Sean Hare was talking about, on the credit side, during the pandemic, you were one of the biggest buyers of loans out there. Are you still buying, and is it easy to get these deals done?
Yeah, I mean, we're still buying debt as we speak. We're very aggressive during the great financial crisis. We bought a bunch of loans. We bought over 50 loans from banks. We bought a bunch of debt during the pandemic. We bought over 180 loans, and we expect that later this year there's going to be an opportunity to buy a lot more paper. We've bought about a dozen loans since the end of last year till now. And it's, a lot of banks, as you've probably read, a lot of the regional banks, community banks, even some of the national banks, they have some challenges across their real estate book, on their loans on real estate, and that's causing them to look at selling that paper.
Can you be a little more specific about what kinds of deals you can get out there or are available to you? If you were to buy an office building, for instance, in Buckhead, what kind of discount would you be able to get? Yeah, I mean, if you're buying an office building, it really depends on the location. It's even in Buckhead, there's different submarkets, different locations. There's, like if you're in the building we're located in, it's probably not trading at a huge discount because it's very well located. It's got great amenities. If you're buying an office building that's on the wrong corner, I mean, the discounts could be 50 to 70%, depending on what's the tenants that are in place and when those tenants are leaving that building potentially.
So we would be remiss if we didn't ask you about hospitality, because of course that is the bulk of your equity portfolio. Sean last week telling us that luxury is doing well, but low end, you're right in the middle. What are you seeing, and what does it say about the consumer? Are we seeing a bifurcation that we're seeing everywhere else for consumers?
Yeah, I think, we're without question, we're seeing that bifurcation today, where you've got the consumers that unfortunately, I would say the consumers that are focused more on the luxury segment, that have a lot of liquidity, they're continuing to travel and spend money. But on the lower side, when you look at just, they're challenged by just the higher interest expense as well as inflation. That's really impacting their ability to continue to spend dollars. So you have seen some pullback in travel. You've seen pullback in them spending money elsewhere in the economy as well. The segment that we're focused on is the mid scale segment within lodging. So it's typically like Hampton Inns, Hilton Garden Inns, Marriott Courtyards, and so forth. They continue to do well. We continue to have positive RevPAR growth across our portfolio. So our revenues per available rooms are still growing, but it's lower single digits. So we're not seeing what Sean's seeing on the higher single-digit range.
All right, really appreciate your joining us. Coming in today, Peachtree CEO Greg Friedman, and of course Bloomberg's Abigail Doolittle, who has specialized in real estate for us. In the meantime, let's just get you a quick check on where things stand with equities. We were at session lows for the S&P and the NASDAQ, and certainly for the Russell 2000 as well. You can see there a decline of 1.2%, with most of the stocks in the S&P 500 lower, 357 decliners, 146 advancers. This comes as we await earnings from Apple and Amazon after the market closes, and of course, before the big jobs report tomorrow at 8:30 a.m. Right now, investors are factoring in 3 full rate cuts for 2024. More Bloomberg just ahead.